Well, Victor, welcome back to another episode of the Beconomics Podcast. The markets have been doing really well so far this year, notching a few new all-time highs. You want to take us through how people should feel getting invested at a time like this?
Yeah, I think investors are a lot of times afraid to get invested at all-time highs. And so I'm excited to address this topic today. I think it's really important because all the time when talking to clients or prospects, you hear, hey, should I wait for some kind of pullback to deploy some cash on the sidelines or to get invested in the first place? Maybe you haven't started investing yet, but you've been thinking about the stock market, but you're going, oh, I see that the S&P is at a new high today and a new high a week ago. And this continues to be a phenomenon. So does it make sense for me to get invested right now? And our answer would be yes. And that's why I'm excited to talk through this topic with you today. And I think it's first and foremost important to mention why get invested in the first place. Why do we invest for clients? Why is this a business to begin with? Well, I think the best thing that an investor, an individual can do is make their savings and their money work for them. If you're still working, you're in the working world, you're earning an income, or even if you're retired, you want to have your money making money for you while you're essentially sleeping, while you're doing your day-to-day business, whether you're retired, doing what you love. Having your money work for you can bring so many benefits when it comes to living the rest of your life with greater assets or more comfort when it comes to retirement. And so I think having those assets producing more income for you is really great. And I know that it can be scary to invest at all-time highs, but as we're going to kind of talk about, it really makes sense for a lot of reasons to be invested right now.
And to that point, Victor, it can be scary getting invested at all-time highs. You're looking at the markets notching new gains, and inevitably all crashes come from an all-time high. So it can be daunting to be able to get invested. But, as we'll talk about, getting invested is more important than waiting on the sidelines and waiting for that pullback. And this really goes into the reasons that it can be helpful to have somebody helping you along in the process, because markets are cyclical and people are, very behavioral in all of this. And those behavioral finance portions come into play. And a lot of these fallacies of, whether it's a gambler's fallacy where you've seen the market go up. So, okay, the next move has to be a down move. Oh, wait, it notched another gain. Better wait for that pullback. And next thing you know, you're not invested at all.
Right. It's our job as investment managers to ensure we take the emotion out of investing as much as possible. A lot of times you've got all sorts of emotional financial biases that will cause you to very frequently, people will hold on to losing stocks for too long, and then they'll sell winners too quickly, trying to lock in that gain. And I think this whole conversation about investing at all-time highs really comes back to what the whole point of owning these equities, owning these assets is in the first place is you want to see price appreciation. So typically, if you're thinking about anything you buy on a daily basis, do I want to buy it when it's most expensive? Your traditional rational thinking would tell you that doesn't make sense. But I really want to step through some of this data, some of this information that brings us back to why it makes sense to be investing now and how actually investing at all-time highs has been better historically than really investing at any other point in the cycle.
Yeah, and a term I really like nowadays is that time in the market beats timing the market. And so whenever you're looking at an all-time high, well, they tend to be clustered together. And so we've already notched over 100 all-time highs so far in the 2020s. Over 200, almost 250 all-time highs in the 2010s. So people see all-time high and they think it's a, once in a while occurrence. Well, no, when the stock market's going up, it's reaching those all-time highs and they, tend to be clustered together like that. So you can't really feasibly just wait for that pullback that a lot of people are looking for. Kind of to your point, people wait for things to go on sale, but it doesn't really work like that with the stock market.
Exactly. And I think what I found really interesting when I was doing research for this podcast was that investing at all-time highs has actually shown better 1 year, 3 year, and 5 year returns than if you were even to wait for a 10% pullback in the market. I've heard investors say many, many times, hey, I want to wait for a pullback to deploy my capital. Well, actually, if you look at periods when you've waited for a 10% pullback on the S&P 500 and gotten invested, your 1 year, 3 year, and 5 year returns are actually worse than had you invested at all-time highs. And it goes back to what you were just saying, is that you have all-time highs clustered together. So when you're investing at that, call it that first all-time high, you're typically going to have subsequent all-time highs after that. And if you're waiting for this 10% pullback, it may not be until the start of a new bear market where stocks are going to trend down for a period of time. I mean, look, we just saw that in 2022. Had you waited for the first 10% pullback, you would have had another 10% downward on your assets had you waited for that long. So investing at these all-time highs is actually just part of the process when thinking about the market is in a bull market territory where you're going to be setting consecutive all-time highs over and over. And so whenever you have momentum in the market, it actually makes sense to ride that momentum rather than wait for a downward trending market and thinking that you're getting better value out of what you're buying.
Yeah, and something I found really interesting looking through this data was that investing at all-time highs yielded very similar returns depending on your time profile there, to just investing every day, just dollar cost averaging in. But the worst thing you can really do is wait for that 10% pullback, which I thought was incredible. And that kind of goes into looking at the long term, investing for the long term. Depending on when you get invested, it's kind of up in the air as far as what the next 3 or 6 month returns are going to look like, because it's really, really tough to pin down on the short term, but really just focusing on the long-term time horizon and investing for the 1+ year returns. And if you're really looking for if you really want to spend money in the next 6 months, you have a house, a car that you want to buy, you shouldn't really be putting that in the stock market to begin with. At these rates, one of the best things you can do is just put in money markets, earn your 5%, because you don't really know what's going to happen in the next 3 or 6 months, but focus on that long-term time horizon for that money that you are putting into equities is the best approach you can really take in a lot of ways.
Right. And I think this goes back to what I was saying at the beginning. Why are we invested in the first place? It's for that long-term appreciation of those assets. If you're going to be an investor, you want to have a long-term perspective. It's just like how you invest in anything else, whether it's in education. I mean, if you're going to an undergrad, getting your college degree, that's a 4-year process. If you're in high school, even, that's a 4-year process. If you're working out at the gym, you don't expect to make significant gains or be ripped up by summer the very next day. It's going to take time. And so investing is all about getting started and building those positions, just as you would in any other kind of investment in yourself that you're making in life. And so I think that the best way to really get invested is to start now, put a plan together. And that also doesn't mean, hey, I have to put all of my money in day one. We actually, as we invest our clients, are pretty cognizant about how we're laddering in our positions in the market. One, because you may want to take advantage of short-term volatility. So say it's a down market day, market's down 1%, and we know that we want to get invested over the next month. Well, hey, let's put our first piece to work today. And especially in the individual stocks that we like right now, maybe some of those are down, and then we wait on the ones that are up, but we know we're getting invested over this next 1, 2, 3 month time frame. And so we've got a plan for how we're going to put that asset allocation together. And that way too is you're forming individual tax lots for your investments, which is really critical from a tax planning perspective, because if you have these individual positions potentially drop in value over a short period of time, you can sell one of those lots for a capital loss, get that tax benefit that you can use to offset the gains that the rest of your portfolio is going to make over the years to come.
And that's something that people don't really want to do a lot, is to take losses in the stock market. But it can be one of the best ways to add value to your portfolio in avoiding taxes on other gains and holding the piece of that same security even that has made you money.
Right. It goes back to those behavioral biases that we're talking about at the beginning of the episode. Prospect theory being that losses are more painful than gains are valuable or feel valuable is something that's extremely common among investors. It's part of the reason why we would suggest to people that if you have a certain level of assets, it makes sense to hire a financial manager like ourselves to take that emotional piece out of the conversation. And also think it does go back to staying focused on the long term and understanding what you own and why you own it. That's something that we really preach to our investors is, hey, these aren't just pieces of paper. These are shares in a company. You have ownership of these companies in your portfolio. You are a partial owner. So understanding what you own and why you own it is a huge piece of the story. And so I'd love for you to also run through a little bit of, hey, why is now a good time to get invested? We've talked on some of our other podcasts about what we think about the current market environment. But if you can kind of give a little bit of background on what's going right in the market right now, what are the market dynamics that make this setup something that can still be attractive for people even when investing at all-time highs.
Yeah. And so we're notching all-time highs right now, but we're doing that for a reason. It's not broad multiple expansion. These are primarily earnings driven, as well as a lot macro driven, because the macro landscape has really shifted a lot in recent months to be a lot more investable. We have the normalization of a lot of risks as far as inflation goes, but also you have a lot of tailwinds coming too. We talk a lot about the AI megatrends out there. AI is a huge source of business growth. You know, it's earnings growth for companies selling the hardware. It's future earnings growth for those investing in it now, but it's just a lot of economic activity flowing around that's going to make a lot of people a lot of money. Along with that, you know, like I mentioned, inflation, that risk has come down. Fed cuts are something we're looking at in the future. It's still kind of up in the air as far as how many we're going to get this year, but that promise of future Fed cuts is really a macro tailwind for the economy, knowing that that is not only an option, but also probably coming in the future.
Right. That's more of a question of when, not if. And so knowing that that macro tailwind is on the horizon is giving us, and I think a lot of investors, a lot more confidence in investing in the market right now. And whether that means just 1, maybe 2% of cuts, it is going to provide a tailwind for your equities, for your bond portfolio, for your other assets, and I think create an economic environment that's a little bit more stable for that future growth that you mentioned.
And it kind of creates a little bit of an economic backstop for any worsening in perhaps the labor market or anything like that. Something that we have now that we haven't had for many years recently is the ability to cut rates. When rates are at zero, if the labor market turns downwards, there's not very much the Fed can do. But now we're at a point where the Fed has a little bit of that dry powder that they can go and stimulate the economy a little bit if needed.
Well, Hunter, I hope that our listeners got some value out of this, why investing at all-time highs actually makes a lot of sense. I know that it surprised me when looking at the data that your returns often end up better investing at all-time highs than waiting or being on the sidelines. And so that's why we would say, hey, now's a good time to get invested, make a plan for your investments, and just go ahead and get started. I think making your money work for you is one of the best things that you can do. And if you just are holding in a traditional checking account or a low interest savings account, it's not really working for you. If you don't need that money, save it, let it grow, whether that means you give it to your children, your future children, or you just provide a better lifestyle for yourself, can create a lot of value.
Agreed. Thanks, Victor.
Thanks.